In 2008, millions of Americans woke up to see their investments slashed in half. Retirement accounts, home values, and job security all crumbled almost overnight. The news called it a shock. Politicians called it unforeseen. But Michael Burry had been warning about it for years, and while my neighbor was wondering how to rebuild, Burry walked away with hundreds of millions for himself and his investors. Here's the uncomfortable truth. Every major market crash leaves clues. Not vague predictions or gut feelings, real, measurable signs. And while the headlines and causes change, 4 of those signs show up almost every single time. And those same patterns? They're flashing again right now. In this video, we're going to walk through 4 massive crashes from the past 50 years, break down the warning signs they shared, and connect them to the market you're investing in today, with Burry's take on it. Because if you can spot these signs early, you don't have to be the person waking up to find your future cut in half. Before we begin, as always, this content is for educational purposes only and is not financial advice. Investing involves risk, including loss of principal. Past performance does not guarantee future results. Always do your own research or consult a licensed financial advisor before making investment decisions. Let's get into the first crash and the first pattern, the 1973-74 oil crisis and market crash. The early 1970s were supposed to be a time of unstoppable progress. Post-war growth had turned into post-war confidence. The United States was the world's economic engine. Manufacturing was booming, and investors believed that modern markets had finally tamed the chaos of the past. Inflation was creeping up, but it was like a slow leak in a tire. Noticeable if you looked closely, but easy to ignore if you didn't want to think about it. Then came the spark. In October of 1973, a geopolitical dispute exploded into an energy shock. Several Arab nations, angered by Western support for Israel during the Yom Kippur War, imposed an oil embargo on the United States and other allies. Overnight, the price of crude oil quadrupled, from roughly $3 a barrel to nearly $12. This was not just an oil problem. It was an everything problem. Transportation costs surged, food prices climbed, factories slowed down. Investors who had been happily buying stocks a month earlier suddenly found themselves staring at stagflation, the economic nightmare of high prices and low growth happening at the same time. And it wasn't just the numbers. Across America, gas stations ran dry. People waited in lines that snaked for blocks, sometimes for hours, just to buy a few gallons of fuel. States even began rationing gasoline, limiting purchases to certain days based on license plate numbers. For a country that had become accustomed to abundance, it felt like a sudden and humiliating reality check. Markets were already stretched before the embargo. The Dow Jones had been trading at elevated price-to-earnings ratios, fueled by years of optimism and government spending during the Vietnam War. The oil shock didn't cause that fragility. It exposed it. The U.S. stock market would lose nearly half its value over the next 2 years, with the Dow plunging from over 1,000 points to around 570. Here's where the first universal pattern shows itself. Macro shocks don't destroy a fundamentally fragile market. Michael Burry has said in different contexts that people often mistake the trigger for the cause. The cause is the vulnerability that builds quietly over the years. The shock is just the match. Fast forward to today, and you can see why this matters. The modern market is heavily exposed to global supply chains, trade dependencies, and geopolitical risk. Tariffs, trade wars, and political tensions, especially with major energy producers, can act as modern versions of that 1973 oil embargo. Burry has warned about the danger of assuming smooth economic sailing when debt levels, valuations, and supply chain fragility are all elevated. And here's the uncomfortable truth. Just like in the 70s, we might not know what the spark will be until it's already burning. Back then, it was oil. Today, it could be a geopolitical standoff, a supply chain choke point, or even a sudden policy shift from Washington. And if history is any guide, the investors who survive won't be the ones who try to guess the exact day of the shock. They'll be the ones who recognize the fragility before it's tested. Which brings us to the next lesson from history. Because while the 1970s showed how fast an outside shock could cut markets down, the 1990s in Japan proved that a bubble can build slowly, quietly, and dangerously, until it suddenly can't grow anymore. By the late 1980s, Japan's economy was a global superstar. Exports were booming. Japanese brands were conquering the world, and the country's real estate market was in a frenzy. At the peak, it was said that the land under Tokyo's Imperial Palace was worth more than all the real estate in California. Banks were lending like there was no tomorrow. If you owned land, they'd happily let you borrow against it. And because land prices were rising so fast, that collateral looked bulletproof. This easy credit kept pushing prices higher, fueling what economists call a self-reinforcing cycle. Rising prices make banks lend more, which pushes prices even higher. It didn't stop with property. Japan's stock market soared as well, with the Nikkei index climbing to nearly 39,000 points in 1989, more than double where it had been just 5 years earlier. Investors, corporations, even the government began to believe that Japan's growth was a permanent, unstoppable force. Then came the turn. The Bank of Japan, worried about runaway speculation, raised interest rates in the early 1990s. Higher borrowing costs slammed the brakes on lending. Suddenly, buyers weren't lining up for overpriced land. The cycle reversed. Falling prices made banks nervous, so they lent less, which pushed prices even lower. Over the next few years, the real estate market collapsed, wiping out trillions of dollars in paper wealth. The Nikkei fell by more than half, and it would take decades to even approach its old highs. Economists call the period that followed the lost decade, though in reality it stretched far beyond 10 years. That brings us to the second universal pattern. Prolonged overvaluation disconnected from fundamentals is a ticking time bomb. Michael Burry has built his career on avoiding this trap. He focuses on the underlying value of assets, not just their market price. In Japan's case, the fundamentals, rental yields, corporate profits, wage growth, simply didn't justify the astronomical valuations. The lesson for today's market is clear. Whenever prices rise far faster than the real-world value underneath them, danger is building. You can see the genes of Japan's bubble in modern examples. Speculative tech stocks with sky-high valuations, certain luxury property markets, and even niche collectibles trading at record prices. Burry often warns that valuation matters, and that ignoring it, because this time is different, is exactly what gets investors hurt. In Japan, the phrase "land never goes down" became a mantra until it didn't. Today, phrases like "AI will always grow" or "megacap tech is untouchable" risk becoming the same kind of dangerous assumption. The Japan bubble didn't burst overnight. It deflated slowly, painfully, and for many investors, it was the slow-motion collapse that was more devastating than a sudden crash. That's because a quick crash can give you a clean break, but a decade of grinding losses can wear down even the strongest conviction. Japan's bubble showed the danger of valuations detaching from reality. The next crash in our story would add another ingredient, one that makes every downturn far worse: leverage. Because, as we'll see in the late 1990s and early 2000s, it's one thing to lose your own money. It's another to lose money you borrowed. By the late 1990s, the stock market was hot. The internet was changing the way people worked, shopped, and communicated, and investors were convinced it would change everything else too. If you had a website and a .com at the end of your company name, you could raise millions of dollars almost overnight. Profits? Not necessary. In some cases, even revenue wasn't required. The business plan was simple. Get online fast, grab eyeballs, and figure out how to make money later. It sounds ridiculous now, but at the time, it was treated like gospel. Companies were going public without a dollar in earnings, and their share prices were doubling or tripling on the first day of trading. Pets.com became the poster child for the mania, selling pet supplies online, spending millions on Super Bowl ads, and losing money on every sale. But the bubble wasn't just about internet startups. Telecom companies were borrowing billions to lay fiber optic cables, confident that internet traffic would grow forever. When reality didn't match the hype, all that debt became a crushing weight. The Nasdaq index, home to many of these tech darlings, soared to over 5,000 points in March of 2000, more than double where it had been just a year earlier. Then the cracks started to show. A few disappointing earnings reports, a couple of bankruptcies, and suddenly the same investors who had been shouting buy were racing for the exits. When the dust settled, the Nasdaq had lost nearly 80% of its value, wiping out trillions of dollars in market wealth. Many companies disappeared entirely. Those fiber optic cables, Some were never even used. So much capacity had been built that it sat idle for years. And that's the third universal pattern: excessive leverage magnifying losses. It's one thing to lose your own money when a bet goes wrong. It's another to lose borrowed money. Leverage can turbocharge gains during the boom, but it turns corrections into collapses. Michael Burry wasn't yet a household name during the dot-com crash, but he was already applying the same discipline that would make him famous later. He shorted overvalued tech stocks after their insider lockup periods expired, betting that reality would catch up to inflated prices once insiders were free to sell. In today's market, leverage is everywhere, and it doesn't always look like a loan. Corporate debt is at record highs, margin borrowing has surged, and entire business models rely on cheap financing. If interest rates rise or revenue slows, that borrowed money becomes a noose instead of a lifeline. And just like in the dot-com era, certain sectors today have an "it will change everything" narrative. Artificial intelligence, electric vehicles, blockchain, where optimism runs far ahead of profits. Burry has warned that markets tend to price in decades of perfect growth in just a few years, and that this kind of optimism is fragile. The dot-com collapse proved that hype alone can fuel a boom, but it also proved that once faith is broken, the fall can be brutal. And that sets the stage for our final crash, one where the hype wasn't about a new technology or an exotic product, but about something far more familiar and seemingly safe: the American home. Because in the 2000s, the belief that another real estate never goes down would lead to one of the most devastating market collapses in modern history, and a trade that would make Michael Burry a legend. In the mid-2000s, the American housing market was on fire. Homes were selling before they even hit the listings. Flipping houses wasn't just something contractors did. It was a weekend hobby for ordinary people. Banks were handing out mortgages like candy, and the message was clear: buy as much as you can, because real estate never goes down. Underneath the excitement, though, something was rotting. Mortgages were being handed to borrowers with little or no proof of income. Adjustable rate loans offered low teaser payments at first, but reset to much higher rates later. And Wall Street? They didn't care. These risky loans were being bundled into mortgage-backed securities, MBS, and sold to investors all over the world, often stamped with a AAA rating as if they were as safe as U.S. Treasury bonds. That's where Michael Burry comes in. A doctor-turned-hedge fund manager with an obsession for deep research, Burry began digging into the fine print of these mortgage bonds. What he found shocked him. Huge portions of them were made up of subprime loans, the riskiest category with the highest chance of default. Even worse, the way these loans were structured meant that once default started, the losses would cascade through the entire system. By 2005, Burry was convinced that the housing market was a bubble waiting to burst. But instead of just avoiding it, he found a way to bet against it. He approached big investment banks with a new idea. He wanted to buy credit default swaps, CDS, essentially insurance that would pay out if the mortgage bonds failed. At first, Wall Street was happy to take his money. After all, in their minds, housing prices had never fallen nationwide. For a while, it looked like Burry was wrong. Home prices kept rising, and the swaps he bought bled money. Investors in his own fund grew restless, but Burry stuck to the data. And then, in 2007, the cracks began to show. Mortgage delinquencies surged, housing prices flattened, then fell. Adjustable rate mortgages reset at higher rates, pushing even more borrowers into default. Once the defaults hit a critical mass, the entire mortgage-backed security market started collapsing. Banks realized the safe assets they held were actually toxic. The credit markets froze. In September of 2008, Lehman Brothers, a 158-year-old investment bank, declared bankruptcy. The stock market plunged, global trade seized up, and millions lost their jobs. For Burry, it was vindication. His credit default swaps paid out massively, earning his fund over $700 million and making him personally about $100 million. But he wasn't celebrating the destruction. In interviews, he said that he felt sick watching the human cost of the collapse. This was the fourth universal pattern. A sudden shift in sentiment turns euphoria into panic. In housing, the optimism was absolute until it wasn't. When confidence cracked, it collapsed overnight, and the very thing people believed could never happen, a national housing price decline, became reality. Today, Burry warns about similar overconfidence in other can't-fail areas of the market, whether it's mega-cap tech stocks, speculative assets, or certain real estate sectors. His point is simple. Nothing is immune to gravity when sentiment turns. And that's the thread tying all four crashes together. Whether it's an oil embargo, a runaway property bubble in Tokyo, an internet mania, or a housing frenzy, the patterns are always there, which means if we can spot them now, we don't have to be caught off guard later. Looking back at the four crashes, the 1973 oil crisis, Japan's 1990 asset bubble collapse, the dot-com implosion of 2000, and the 2008 subprime meltdown, it's tempting to think they're all unique. Different decades, different countries, different industries. But peel away the details, and you see the same patterns repeating like a market déjà vu. First, overconfidence and speculation. In the oil crisis, the assumption was that post-war growth could go on forever. In Japan, land prices could never fall. In the dot-com era, internet companies couldn't lose. And in the housing bubble, real estate was the safest investment in the world. Today, we hear similar tones around artificial intelligence, mega-cap tech, and niche speculative assets like certain cryptocurrencies. And Trump's recent push for aggressive economic optimism, from campaign promises of endless growth to claims that America's markets will never crash on my watch, only adds fuel to that confidence. When the crowd stops asking what something is worth and starts buying just because it's going up, you're in dangerous territory. Second, regulatory blind spots. In the 70s, policymakers underestimated how an energy shock could unravel the economy. Japan's regulators let debt-fueled property speculation run unchecked. The dot-com boom saw a surge in IPOs with questionable oversight. And in 2008, mortgage fraud and reckless lending flourished under the noses of regulators who thought the system was too big to fail. Today, think about emerging sectors, AI, fintech, and even private credit, where growth is outpacing guardrails. Third, leverage and financial engineering. The oil crisis was amplified by heavy borrowing and inflationary pressure. Japan's bubble inflated on cheap credit. Dot-com telecoms borrowed billions to lay unused fiber. In 2008, mortgage-backed securities were stacked on top of each other, with leverage at every layer. Now, corporate debt is at all-time highs, consumer credit card balances are breaking records, and speculative investments are often funded with borrowed money. Fourth, a sudden shift in sentiment. Every bubble has the same cruel ending. Not when the last buyer runs out of money, but when belief itself cracks. It's almost instantaneous. 1 month, everyone's confident. The next, panic sets in. You can see flickers of that today in sectors where a single earnings miss can wipe out billions in market value overnight. Trade wars during Trump's presidency showed how quickly market sentiment could flip with a single policy announcement. In today's volatile climate, one unexpected move, tariffs, sanctions, or even a sudden change in Federal Reserve policy could be the spark that turns optimism into fear. Michael Burry's approach ties all of this together. He doesn't predict dates. He studies behavior, valuations, and risk buildup, then positions himself for when sentiment turns. And right now, he's publicly warning about pockets of extreme risk. In fact, if you look at his most recent 13F filing, you'll see that he has sold off all of his positions except one, signaling that something big may be coming. Whether he's exactly right this time isn't the point. The point is that the patterns don't lie, and we're seeing several of them again, which means we should be thinking less about if a crash will happen and more about how ready we'll be when it does. Market crashes have a way of feeling sudden, but as we've seen, the signals usually show up well in advance. The good news? If you start preparing while things are still calm, you can avoid being one of the investors who panic sell at the bottom. First, get your financial foundation in order. That means lowering high-interest debt, like credit cards, which can crush you if the economy slows and interest rates rise. Michael Burry's philosophy is rooted in margin of safety, keeping enough cash or low-risk assets so that you're never forced to sell at the worst possible moment. If you have an emergency fund covering at least 3 to 6 months of expenses, you're already ahead of most. Second, diversify without overcomplicating. In 2008, many thought they were diversified because they owned multiple real estate investments. But when housing collapsed, all those investments sank together. True diversification means spreading risk across asset classes, stocks, bonds, cash equivalents, maybe some commodities, and across sectors. That way, you're not relying on one single bet to carry you through. Third, keep some dry powder. Crashes turn solid companies into bargain buys. Burry's greatest trades didn't just come from spotting risk, they came from having capital ready when opportunities appeared. This doesn't mean sitting entirely in cash, but it does mean resisting the temptation to be 100% invested at all times. Fourth, watch sentiment, not just numbers. Prices are important, but mood drives markets. In every crash we covered, there was a point where the crowd's confidence flipped. Today, you can monitor this by paying attention to volatility indexes, margin debt levels, and the tone of financial media. If headlines go from cautious optimism to euphoric certainty, that's a yellow flag. Fifth, don't try to time the bottom. Crashes often overshoot on the downside, and recoveries can be surprisingly fast. Instead of betting everything on one perfect entry point, plan to buy gradually during downturns. Stay calm, skip the hype bets. And remember, the words, "this time it's different," have burned more investors than any crash ever could. Trump's adding trillions to the national debt, but could it be a planned market crash? Click the video on screen to find out.